Hello traders, welcome to binaryoptions.net.au. Today we're going to teach you how to trade with the stochastic oscillator. First of all, let's understand the stochastic oscillator. There are two extremely important rules we must understand before continuing. One, the stochastic doesn't follow price or volume, it only follows the momentum of price. And two, momentum changes direction before price. This is why the stochastic oscillator is one of the most used momentum indicators out there. The stochastic compares a security's closing price to its price range over a given period of time, and the indicator consists of two moving averages that oscillate between 0 and 100. The first moving average is the %K, and its calculation is the current close minus lowest low divided between highest high minus lowest low times 100. This is not very important, but you might as well know what you are trading with. And the %D is the 3-day simple moving average of %K. Here's a naked chart of the US dollar Canadian dollar 15-minute time frame with the stochastic oscillator plugged in it. As you can see, the oscillator fluctuates between 0 and 100, and we have two levels, the 20 level and the 80 level. An overbought condition is when the stochastic oscillator is fluctuating between 80 and 100, and an oversold condition is when it's fluctuating between 20 and 0. And as you can see here, when the stochastic oscillator fluctuates below the 20 level, we are in an oversold area, and when the oscillator turns back up and crosses above the 20 level, we have a bullish engulfing candle and a continuation of the trend to the upside. Then when the oscillator is in an overbought area and crosses below the 80 level, we have a continuation of the move to the downside. So as you can imagine, the stochastic oscillator is very useful in ranging markets. The first setup we're going to be using with the stochastic oscillator is the overbought and oversold setups. As a bound oscillator, the stochastic makes it easy to identify overbought and oversold conditions. No matter how fast the security moves and no matter how long the trend is, the indicator will always fluctuate between 0 and 100. This is important, and you're going to see why in just a minute. This reading don't always mean that we have hit a turning point for a reversal. Of course, if we are in a ranging market, an overbought reading is the top of the range and an oversold reading is the bottom of the range. But if we are in a very aggressive move to the upside or to the downside, an overbought and oversold condition don't always mean that we have hit a turning point and we are due for a reversal. We are going to see why right now. Unlike ranging markets, in aggressive moves, it's better to use these readings to trade in the direction of the trend. Okay, so overbought and oversold conditions in ranging markets are very easy, and you already know how to do it. The overbought conditions at the top of the range gives us signals to buy puts, and the oversold conditions at the bottom of the range gives us signals to buy calls. And with this knowledge, we're going to go and see how do we use the overbought and oversold setups to trade in the direction of the trend. So this is a range-bound price action, and as I already told you, when price hits the top of the range and the oscillator is giving us overbought conditions in the market, and when we cross below a significant level of support, we have a signal to buy puts. And on the other side, when we hit the bottom of the range and the stochastic oscillator is giving us oversold conditions, and when we cross above a significant level, we have a signal to buy calls when the oscillator crosses above 20. This is the simplest way to trade the overbought and oversold setups. Now, let's see an oversold signal in an uptrend. As you can see here in this example, we are moving up. Okay, And this stochastic oscillator is following momentum to the upside. We hit a level in price that is just unsustainable with the main move. This means that the move has been very steep and we are due for a correction. You can see this because we are hitting overbought readings in the oscillator in an uptrend. And as you can see, when the oscillator crosses below 80, we have a small correction to the downside. Then we hit a previous area of support and we have oversold conditions in an uptrend on a correction. This gives us a signal to buy calls and to trade the trend, or to get it onto the main move and trade the direction of the trend. So to make it step by step, you need to first identify the direction of the trend. In this example is up. When we hit overbought levels, you wait for the correction. Then when we hit oversold levels and our previous level of support, and we move back up to the 20, we have a signal to buy calls and trade the trend. And the same thing applies for a down move. Here we have a very aggressive move to the downside. We hit an oversold condition in a downtrend, meaning that we are due for a correction. When we hit previous levels of support now being tested as resistance, and the oscillator is giving us overbought conditions, and when we break below a significant level of support, we have a signal to buy puts and to trade the main move. So this is how you trade the overbought and oversold setups with the stochastic oscillator in range-bound markets, in up markets, and in down markets. Now let's go to the second setup we can use or we can look for with the stochastic oscillator. Of course, being an oscillator, we will have bullish and bearish divergences. Since the stochastic oscillator fluctuates between 0 and 100, no matter how fast price is moving, sometimes in extreme moves at the tops of bottoms of these moves, the indicator will read exhaustion of these moves as divergence from price. Okay? A bearish divergence happens at the top of an uptrend and signals a short setup to buy puts, and a bullish divergence happens at the end of a down move and signals a long setup to buy calls. This is an example of a bearish divergence. As you can see, price is making higher highs and the stochastic is making lower highs. When price reverses and takes out the previous low, we have a signal to buy puts. Okay, this is a very typical and very normal bearish divergence with an oscillator. And on the other side, we have bullish divergences when price is making lower lows and the stochastic is making higher lows, and we take out the previous low, the previous high, we have a signal to buy calls in this case the euro US dollar for our chart. Okay, so these are your basic bullish and bearish divergences on the stochastic oscillator. Bearish divergence is when price is making higher highs and the stochastic is making lower highs, and bullish divergence is when price is making lower lows and the stochastic is making higher lows. But this is not the only divergence setup that we can find on the stochastic oscillator. We also have the George Lane's bull and bear setup. George Lane identified another form of divergence to predict bottoms and tops. And this is what's cool about this oscillator or this indicator, that we have plenty of setups to look for. And if we're monitoring 6 currency pairs and 2 stocks, we will definitely find enough setups to keep us occupied during our trading session. A George Lane bull setup is basically the inverse of a bullish divergence. Now stick with me, and I know this may sound a little bit difficult, but stick with me and I'll make it very comprehensible. So a George Lane bull setup is basically the inverse of a bullish divergence. Price makes lower highs and the stochastic makes higher highs. Okay, but we need a decline after the bull setup and a break above the last high for an entry. A George Lane bear setup is the opposite of a bearish divergence. Price makes higher lows and the stochastic makes lower lows. We need a bounce to the upside after the bear setup and a break below the last low to get an entry and a signal to buy puts. Yeah, I know this sounds a little bit difficult, so let's go to some examples of these setups, okay? Now, here you have a George Lane bull setup. As you can see, on a down move, price makes lower highs, but the stochastic is making higher highs. After we get the bull setup, which is lower highs in price and higher highs in the stochastic, we have a decline in price. And when we take out the previous high, we have a signal to buy calls. This is a George Lane bull setup. Now, this is a George Lane bear setup. We have here the stochastic is making lower lows, but but price is making higher lows. Okay, and after we get the bear setup, we have a bounce to the upside before breaking with this low, which gives us a signal to buy puts in the Euro US dollar 4-hour chart. Okay, so there you have it. Those are all the setups that you can look for using this stochastic oscillator. And right now we're going to go to the MT4 platform to look for some setups of our own. I don't know if we're going to find every single setup we just went through, but at least we're going to try to find a few of them. Okay, since we are we are during the Asian session, we are going to be reviewing these setups with the Aussie US dollar. And the first thing that you can notice is that we are on the Aussie US dollar 4-hour chart, and we have no indicators on it. So the first thing we're going to do is add the stochastic oscillator by clicking the plus sign, going to oscillator, and then choosing the stochastic oscillator. We have added the 50 level on the stochastic oscillator just to get a feeling of a bear bull market line. And of course, the default periods are for the 14K it's the 14 period. For the percent KD is 30 period. Okay, so we plug it on a 4-hour chart. And if you're going to be day trading, remember to draw your levels on the 4-hour or the 1-hour chart, because the levels are so much strong than the ones on the 50-minute, 5-minute, or 1-minute chart. Okay, here we are filtering out the noise of the market. Okay, even though price has been in a very deep uptrend, we are now 450 pips up since this low. Okay, since this correction, without having without having deep corrections such as this one. This correction was about 150 pips. So we are counting from this low to this high, 450, 460 pips, and I think we are due for a correction, and the stochastic oscillator, of course, signals the downside. But we are here to trade the 50-minute chart, so we go to the 50-minute chart, and we are going to look for trading opportunities. Now, we have these highs right here, okay, that price broke with, and what we're going to do right now is we're going to look for the first setup that we can have with the stochastic oscillator. Okay, now what do we have here? Okay, price is making lower highs. Okay, remember, price is making lower highs, and the oscillator is making higher highs. Okay, and now what do we get? What do we got here? We got a dip to the downside. Okay, after the George Lane bull setup. I think what we have here is a definite bottom of the down move. So in order for this uh, setup to be valid on the 50-minute chart, of course we have to break with this high right here. So now that we have defined that we have a George Lane, or we might have a George Lane bear bull setup in play, we need to define the level that we need to break in order for us to get a signal to buy calls. If we break with this high at the 93.84 level, we have a signal to buy calls in this currency pair, and on the 50-minute chart we can choose an hourly, maybe a 2-hour expiration, and it will be fine. Okay, so that's the setup that can be in play right now. Okay, and let's continue. For instance, here we have a clear overbought signal that gave us an entry when we took out this low. Okay, remember that we are in a steep uptrend. When we are in an uptrend, we are making higher highs, higher lows, and of course higher highs. Okay, when we get a an extreme, I'm sorry, let me just regrab my rectangle, an extreme overbought signal, and then we break with the up structure. Breaking with the up structure means that we take out the last low. When we take out the last low, retest the same level, this level as resistance, and then break to the downside, we have a signal. And of course, the stochastic oscillator breaks below the 80 level, we have a signal to buy puts on the Aussie US dollar 50-minute chart. And if we choose an hourly expiration option or a 2-hour, our option will have expired in the money. Okay, now let's continue because we have some cool setups to go through. Okay, now this is a ranging market. Okay, and this is the most basic use of the stochastic oscillator. We hit the top here. Oops, I'm sorry. We hit the top here, okay, and we hit a overbought reading on the stochastic oscillator. We hit another top here, and we hit another overbought reading on the stochastic oscillator. But here's where things get very interesting. Okay, we have a super strong move to the upside that breaks with these highs and this level of resistance. Okay, then price starts to fade to the downside, but look at the stochastic oscillator, how it goes all the way down to uh, oversold conditions. Okay, and we are in an uptrend. So what happens here? We are using the oversold conditions to buy calls and get in on the main move, which is to the upside. Okay, so as you can see, with this stochastic oscillator, once you have mastered it, you can actually get a lot of signals, and if you get confirmation that these signals are valid, you will be in high probability trades.